All right, all you devils out there, Sam here with you now on, well, let's see, it's Sunday the 10th of April here. Now, I've been trying to get this to you for some time here. Those of you that know our content over in the futures market that is oriented towards Ninja Trader, we released this for that market, I think a couple of weeks ago, and have been working to flesh it out and get you some solutions here for those of you that are working exclusively with TradingView and that may not be futures traders that are much more focused on crypto or traditional assets outside of the futures market. So I'm very pleased to finally introduce this to you. Now, this is really just a mini introduction to what you're about to see. Now, I want to preface it by saying the goal here is in no way to take you away from the content that we've already been teaching and training you on. This is really designed to augment that, just one additional, almost confluence point, if you will, with regards to entry and exit targets, those types of things. I will tell you this, that once you've seen this lends itself to almost a complete trading solution. I guess that's probably the best way to say it. And it's become very, very popular in the last 5-6 years. To the point where, particularly with younger traders, I'm noticing as I look around the space and see who's gravitating to this, I would tell you that this style of trading, particularly with younger traders, is already, I would tell you, is probably more popular than Elliott Wave trading. If I look at new traders coming up, this seems to be very appealing to a younger than I, right? Younger generation. So when I saw it, what I saw was how it complemented what we were doing. But I also noticed that many traders, particularly, let's call them 25 to 45, in that age bracket, were really gravitating towards this. I'm not so sure that I would say it's easier than Elliott Wave. I mean, there is no easy path to success in the markets. But I think this may be more palatable. There's less to memorize, but it certainly is a bit deceptive at first glance. And I don't want you to see this and think, oh, well, it's going to be easy. It's not. It's very nuanced. It will look deceptively easy at first glance. Once you start trading it, or even in sim or practice or backtesting, you'll find that there is much nuance to it. And there's a logic to it that attracted me to it that I think you may find appealing, particularly if you struggle with Elliott Wave and some of the issues that we all run into as Elliottians in the subjectivity or the interpretation that can be there, i.e. 5 Elliottians can give you 5 different counts. Here, there's a logic and a specificity to swing structure here where we can be very specific about uptrend, downtrend, where support, where resistance lies. And I think that may be appealing, certainly to those of you that perhaps are struggling with Elliott Wave. Maybe you're not seeing the success you had hoped. Maybe you're bored with it. Maybe you don't like it. So rather than have you just discard that and perhaps go off seeking some other approach to the markets, I thought this could be a nice augmentation. You certainly can build this into all of the analysis that you're currently doing. I mean, at the end of the day, this is selling resistance and buying demand. I mean, really can be simplified down to that level. But again, what you're going to find is that it's much more nuanced than that. So with that said, I'm hopeful that those of you that perhaps are not clicking with Elliott Wave, this gives you another way to approach the market that can be very appealing. I think you'll very much like the very favorable risk reward scenarios that this creates if you're trading this approach. And that's one of the big attractions to it. Again, there's a lot of nuance to it, but we can simplify. And here, as I first introduce it to you, I'm going to keep it on a relatively simplified basis. You can get more complex, and that will be something we'll probably head into. But initially, I just want to go through the basic logic of it, get you familiar with it. You'll hear me and see me start to incorporate this into the analysis that you regularly see me do, whether it's on a Friday or a live stream or charts that we're posting. You'll start to see this now in our work because I think it complements what we're doing very nicely. So With all of that said here, let me quickly transition to this. You're going to see theory initially, then you're going to see some examples in the market. There will be follow-up videos on this, so at the end you're going to be left a little bit frustrated that you can't get access to what I'm going to show you, but trust me that it is coming very, very shortly. You will have access to it soon. But before you get into working on TradingView with tools and software and indicators that we're going to introduce to you, I want you to understand the theory and the logic of it first, right? Before you dive into something and you're not quite sure what you're doing. So that's the intention here. So I hope that you'll work your way through this. This is a relatively long video. I know that's annoying at times. You could probably do this at 1.25, even 1.5, right? I mean, it's long, right? It's well over an hour. But I think you may find yourself going back and rewinding, rewatching. When you take it to the market, it's going to be a little tricky at first. Trust me on this, because I've been in a deep dive on this for several months now. It's not as easy as it appears at first. Right, so with that said, there's the cautionary tale. What you're going to see are some great examples of where this could be very appealing to you, again, for all the reasons I just noted. Okay, so with that said, let's transition right into it. I'm going to try and do this as briefly as I can, but I'm going to need to go through a little bit of theory, and then as quickly as I can, we'll move through the theory and then into application so you can start to see the pieces come together. Now, we call this price action trading, but now, of course, price action trading is, I mean, everything is price action trading, but it really, this moniker of price action trading, it's really, I suppose, pioneered in the early days by Al Brooks. I guess you'd call that classic price action trading. And it's conceptually, it's the idea of trading purely based off of price action or a candlestick chart, and you're not relying on indicators. So that's kind of the historical reference to price action trading, if we use that category. Now, of late, let's call it the last 6 or 7 years, a subset of price action trading has become quite popular. It came from the Forex markets. Now, the Forex markets are unique unto themselves, unlike other markets, for a couple of reasons. Well, number one, they dwarf every other market I mean, if you combined all the trading in every other market and tallied it up, Forex would still dwarf it. I mean, it's trillions and trillions of dollars exchanging hands every single day. Now, what additionally makes it unique is that of those trillions of dollars that are moving back and forth throughout the course of any given day, about 90 to 95% of that is done through 6, 7 major institutions, banks, if you will. So that unto itself makes the market unique. The size, the fact that there are relatively few players that move money back and forth. And then additionally, the fact that the Forex markets are not centralized. So the exchange prices vary, volume would vary. So because they're not centralized and the price on one exchange is not necessarily exactly the same on another exchange, a couple of things happen. One, Forex traders do not get volume. They can get tick volume, but they don't get actual volume. Additionally, in the Forex markets, we have traditional market makers, right? Because of that. Because of the lack of centralization, there are market makers that are providing liquidity, and that creates some interesting interaction between those mega institutions that are moving money around and then the interaction with market makers. So it creates somewhat of a unique concoction of dynamics in the Forex markets. Now, the subset within price action trading that has been popularized in the last half dozen years or so came from, I don't know if he started it, but he popularized it. So let me say it that way. One individual trader, educator, really popularized the idea of the smart money concepts, or SMC, as you will often see it abbreviated. And the guy behind this, at least popularizing it, I believe his name is Michael Huddleston, and he goes by the handle of the ICT, or the Inner Circle Trader. Now, this is I suppose he's a semi-controversial character. It's either a love or a hate. Some people are completely devoted to his teaching and swear by it. Others will tell you it's garbage, doesn't work. you have to draw your own conclusions there. And I will say very, very specifically early on here in this presentation, we are not trying to replicate the smart money concepts that you find in the Forex markets here in the futures markets or even the crypto markets. We're not trying to replicate that precisely because there are nuances that are specific to the Forex market. What we're trying to do here, and what I typically will try and do, is look at a technical approach like this and pull out the strengths and then leave some of that nuance or some of the peculiarities that are specific to the FX market for FX traders. What we're going to do is look at the price action, if you will, the price action side of this, and then extrapolate from that some of the benefits of what I think is available to us here as traders as we implement this and look at how it can overlap with what you're already doing. Or certainly you could approach the market with this technique and trade it exclusively, or you could add it in and augment what you're currently doing, which is typically what I do. But before we get into the specifics and we get into the indicator and we get into the charts and the real time and we demonstrate it, we got to go through a little bit of theory here. So if you'll bear with me, some of this is going to be, it's going to strike you as very rudimentary because it is. But when we move beyond theory and line drawings, and then we get into the charts, you'll find that it's a little trickier than you might believe at first glance, right? So when you first see what I'm about to take you through, you're about 5 minutes into this, you say, yeah, I got it. Well, okay, so bear with me, if you will. There's a destination in mind here. But as we work through the very fundamental theory here, eventually when we get to the charts, I think you will, like I did when I first started applying this, find that it takes a little bit of practice. It takes a little bit of time for your eye to see what I want you to see and what hopefully I'm going to open your eyes to if you've not seen this before. And I think there can be real benefit here for us as traders, whether you want to incorporate this into what you're doing or do some experimenting with it in either futures or crypto or whatever market you currently trade. Certainly, you can take this into the FX markets. Okay, so enough introduction there. So with that said, let's deal with some of the basic theory here and get this out of the way. Okay, so one thing I've got to do here, because you can't see my mouse here, so I've got to use this little laser pointer here since I'm doing this on a PowerPoint presentation here. Okay, so if you'll bear with this little laser light. Okay, so this is certainly not revolutionary to price action trading. This is how trends have been defined for as long as people have been writing down prices and putting together the bar charts or candlestick charts. So this is simply just the definition of a trend, a series of higher highs and higher lows. Well, now we're going to put in some specific language here to refine and define these more clearly. So in this context here, I've got a swing that gives me a high. I get a retracement that gives me a high or low. Now, in order to identify the ongoing trend, I need a break of structure. So I need this low to push past this high to give me a higher high. And then we're going to call that move where we break this prior high a break of structure that leads to the new high. Retrace, I get a higher low, I get another break of structure, and on we go. Of course, it's the same thing coming down. Absolutely as rudimentary to technical analysis as it can be, very deliberately so. Now, with that said, that's the theory of a perfect line drawing here. And of course, that's not how the market is going to necessarily present itself to us. So often we'll have a swing here, and then we'll have an uptrace here, and then there'll be internal swing structure here. But the broader swing structure here is not changed unless we were to come down and take out this lower low down here. Well, here, if I switch to the pen tool, let me try that. So here's the low that's important that drove off and gave us this higher high. I've heard it described this way by another educator in the SMC space, and I liked it, so I'm going to borrow it. In the context of an uptrend here, or downtrend, either way, once we create a lower high here, if this trend is going to continue, if we're going to continue in this uptrend here, then this low has a job to do. It has the job of creating a new high. Let me go back to the laser, right? So this low has a job to create a new high. In order to do that, it has to break the structure of the prior high. Now, inside the internal swing structure here, which is well, of course, that's what the market will present to us here. Now, we'll deal with this as we progress through this little presentation, but for the time being, what I want you to focus on here is that this is the strong low. If I go back to my pen toe, here's the low that matters here. So we are in the range here between this low and this high. All of this is not relevant to my swing structure unless it either breaks the low down here or breaks the high. Right? If we break the low, well, our trend has broken. If we continue on and we break the high without breaking the low, then of course we have the ongoing trend. Higher high, higher low, higher high, higher low, and of course the exact same thing on the way down. Now, moving forward, of course, what this creates for us is some specificity with how we're identifying highs and lows. So let me go back to my laser here. So with the swing here, that retraces. Now, at this point here, we don't know the outcome. We just know that we have a swing, and at this moment in time, we have a retracement internal to those highs and lows. If the market is going to continue to move higher, we have to break the prior high. If it produces a higher high, then this becomes a strong low because this is the low that did its job of creating a higher high. So this in turn becomes a weak high as it was broken by the strong low. Right now, if we start to retrace, we do this again. Now here, again, I don't know the outcome. I just know I have a stronger low below. And as long as we stay above this low, I have the potential for this trend to continue. It continues only if and when I break the prior high, which gives this the identification as yet again another strong low because it broke the high, making this a weak high, and now we get another high. I don't know what this is going to be at the time, and if I get a retrace here and then that breaks, then I get another low here, another strong low that breaks a weak high, and on, right? And of course, the same thing coming down. But it lets us specify strong or weak. What is the current range that we're in? Now, this will be important here as we add complexity to this, but I just want to start you here on the basics. Now, of course, the market's not going to give it to you in that perfect line drawing format here. We're going to get a swing, a retrace. We don't know if it breaks. Oh, okay, I got a weak high, I got a strong low. Then I'm going to have all of this swing structure here, this intermediate swing structure here. This could be a 4-hour chart, and this would be 15-minute substructure here. That all, of course, this is just naturally how the market moves. But our context here doesn't change as long as we stay above this low. As long as the uptrend stays in place, we continue to define it as an uptrend as long as the highs are being broken and the lows are staying thus as higher lows. Right? Higher low, weaker low because it breaks. So and of course, the exact same thing coming down. We will get to this substructure here because this can be useful to us as we progress. But let's just stay with the original concept here of defining trends through those structures up and down. Now, how do we define a trend change? Well, okay, we got to be specific here. So just staying consistent with what we've just been looking at here in terms of the uptrend. I'll pull that off here. So if we now are going to start to look at the potential, how do we define a trend swing? A trend change. Let's be very specific about it. Well, when we get to this point here, well, let's use my laser here. When we get to this point here, I have a break of structure. So this is the low that did its job, that gave me a higher high, but on the retrace here, I did not get a higher low, right? So this is a pivot high and that was intended to retrace for the trend to continue. I'd need another push to give me a new high, but I get a break of a strong low, right? So this is the initial condition for the potential for a trend change. Now, let me go back to the pen here. Now, just because we have this break of structure here, that does not necessarily by itself determine the swing trend. The trend change, because we could easily just blast off from here and trend continues on. And this was just a bit of a fake break, if you will. The trend stays intact and off we go. We get a new high here, and this was just a little, a deeper retracement. Happens in the market all the time. But when where we can and when we can, we want to try and identify when those trend changes are happening. So this is the first conditional component of a trend change. We get a break of structure, but I can't call it that by itself a trend change. In order to confirm the trend change, I need a retracement that will give me a lower high. And in turn, this lower high has to give me a break of structure that will give me a lower low. So when I have those conditions, now this becomes the stronger high, this becomes the weaker low. I get a confirmation here because I get a lower low. So this is the pivot. This pivot high did its job of creating the lower low. Right? So this is the first condition, break of structure. Then I need a retrace here that gives me a lower high than the previous strong high here. And then I need a secondary break of structure here to confirm the low so that I know in turn that I have now a stronger high here that produced a lower low. So this is the pivot that did its job. Now, if I retrace and that continues, I get another strong high here. It's a lower high. It does its job. It breaks the structure. This becomes a weak low, gives me a strong low here because this pivot did its job, gave me a lower low. Right now, so if we're going to come back the other way, let's erase that. Let me come back here. If we're going to come back the other direction and we're going to get a second trend change, right? If the trend is changing throughout the course of the day, of course, it would be a function of the time that you're trading on. This could be a 1 minute chart. You get trend change 12 times a day. If you're looking at a monthly or a weekly or a daily, not so much. But here, the time frame doesn't really matter. I just want you to understand conceptually how we define the trend change. Now here at the break of structure, yet again, this is not the trend change. This is the start, the conditional start of a potential trend change. If I get a higher high here, then this low has done its job of giving me a higher high. I need a retrace. Now, is this low going to do its job? If I get that break of structure and it gives me that higher high, then I get a stronger low that breaks the weaker high. And then we have the conditions for that trend change. But I can't confirm the trend change. As I said, just to emphasize this again, I don't have a trend change here. I have the conditions for it. I don't confirm the trend change until I get the second break of structure, so I know I get a higher high. All right, so hopefully that makes sense. We got to be specific about how we define a trend change here. So while there are some that might tell you, oh, with just a break of structure here, oh, we've got a trend change. No, we can't define it till we get the lower low. Okay, with that said, now let's talk about some of this internal swing structure here. Well, so here, if we were looking at some of the internal subswing structure here, well, here just clearly, if we got a series of higher highs and higher lows, when we come to this point here, I have not necessarily a break of structure, but I have a change of character. Now, change of character, this is, we're going back to Wyckoff days here. We're talking about change of character. But it's applicable here. So it's not, a change of character is not necessarily a break of structure. It could be a break of structure, right? But that's a function of what's the range that we're trading in. So let me go back to my laser because I think this gets harder to see. If this is the dominant low here, and this is the structure that we're in, this is the dominant high, these internal swings here, we can see a series of higher highs, higher lows. We can see that substructure change without changing the larger degree trend. Right? So these little internal changes of character are meaningful. This is often how we'll set up a trade, but we want to be mindful of what the larger, the higher degree trend is, so we know whether or not we are looking to get in alignment with that larger degree trend or if we're counter trend trading. Right? Just we want to be clear about how we're defining things. Now, of course, again, the market is going to give you a little bit more complexity than what we're seeing here in these line drawings here. So here we get a nice uptrend here. Now, this little pivot here, at this point here, nothing has happened here because we're still within the uptrend. But when this series of higher highs and higher lows, all of a sudden, I get a change of character here because all of a sudden within the internal substructure, I get a lower low. Now I get a lower high. Now, it's important that you recognize here that I do not yet have a trend change here. Just as a result of the change of character in the internal high, I have a break of structure here that creates the trend change, just as we went through it previously. A change of character is not a change of trend. It's not until we have a break of structure where we have the first ingredient of the change of trend. I don't confirm it until I get a lower high that gives me a lower low. Thus, now at this point here, I know I have the conditions for the trend to have changed. And the same thing here, and there'll be more complexity here. Again, of course, the market's going to make it a little trickier for you, but uptrend, is just as we looked at it over here. We get a little change of character here. Now we can get complexity here where we can have multiple changes of character within that substructure, but the broader trend remains intact. Right? This is most commonly what you're going to be faced with when we go into an actual price chart here. So here, this is what you'll be faced with when you're trying to apply this to a chart. Now here I've marked out all the breaks of structure and all the changes of character along with the higher highs and the higher lows. Here, I think this is a 5-minute of the RTY. So what you'll note here, and it takes a minute, again, for your eye to see it. Oh, let's get my laser. Here, let's do it that way. So from the low here, first thing I get is a break of structure, right? Then I get another break of structure. So I have an uptrend coming into this, right? It wouldn't matter. It was just in this section of the chart here, I've got a break of structure. So I have an uptrend here. Now I immediately fall into a downtrend after that uptrend. So here's the break of structure that sets up the initial, that's just the potential for the trend change. Here's the second break of structure, third break of structure. Right, so I've gone from this uptrend to a downtrend, and now I go back into an uptrend, right? So here's the break of structure. As we get that, so we get change of character, break of structure, gives me the new high. Now I come back down, I got another break of structure, another break of structure. Right, so now I've gone into a downtrend. Now here, I get one break of structure, I don't get the second. So I retrace. This is a teaser, a fake break. Now we come back down. It's a break of structure here. So certainly the conditions are there for a downtrend to establish. Now I get the change of character, break of structure. Down we go, and then I get another break of structure here. So I confirm it here because now I've got two breaks of structure. So we've gone from uptrend, downtrend, back into uptrend. Right, now this is a 5-minute chart. So here's break of structure. Here's a little fake break. I break structure here, but I don't get a trend change. Now I'm back to here. I have both a change of character and a break of structure. So now I go into a pretty serious uptrend. Here's another little fake break here. I don't get a trend change. I carry on because here's the break of structure here that leads to this break of structure. Then I get another break of structure. So my point being, line drawings are going to make this look easy. Once we get to a chart here, marking all of this off and trying to follow it, and what are we in an uptrend? Are we in a downtrend? Where are we? Can get a little more challenging, which is why I wanted to take you through the theory first. So as we take this to more and more examples, it'll start to get easier for you to spot these here. Now, one of the things that I want to focus on here is just kind of coming back to keeping it a bit simpler here, if you will. So we will return to the complex momentarily here, but let's just focus on this here. So this idea, one of the things that we know about the market is it likes to find a range. You can consider this consolidation. You could consider this where the market's found fair value here. I guess we can switch that off. We found value here. We found a range. Time frame wouldn't matter. This could be a 1 minute. This could be a daily chart. Doesn't matter. Once we break out of this range, we come down here. We have imbalance, right? And it's emphasized here in this last candle. So we've moved from a place of value or consolidation or however you want to think of it, a consolidation here, and we're now moving away from balance through imbalance, and we're seeking new value. So we find it down here. Again, the time frame wouldn't matter. This could be a 1 minute chart. It could be a 4-hour chart. We find a new range of value, a new range of balance. Now we come out of that via imbalance. Right now, are we going to hold here, or are we just going to carry on? Well, of course, we don't know until we see the results of. Here, let's get this off of here. Oh, hang on a sec. Let's get off that here. So as we push into that, we don't know the result here, but we can spot the new range as the market wrestles with whether or not this is going to be value. Are we going to stay here? Are we going to move on? Well, in this case, we move on. So what you can see here is we've gone swing, we've had retrace, and now we go forward and swing, right? So the swing structure here is moving. Now, of course, we could look at this a couple of different ways, but for the time being, for just this first example, let's just focus on this range here and how we might deal with that kind of a range. So we can identify it, and here, if you would allow for this to have blown it up. Again, wouldn't matter if this is 1 minute or a 1 month. It just wouldn't matter here. So, but we find ourselves in this range. So how we can qualify the range. just by cutting it in half. Now this is, when we see something like this, this is, we could kind of find ourselves in the language of overbought, oversold, overbought, oversold. And here, this is, if you're tracking indicators, this can often be an area that will give you some opportunities here, but we just are identifying it as a range. And we can approach the range by looking at the lower half of it here. If we just cut it in half, we can define the lower end of the range. Let's go back to my laser here. This as being the discount, equilibrium being at 50%, and then the upper half being at premium. So ideally, right, we want to sell high and buy low. If we can buy low and sell high. Now, of course, that's idealized, right? That's usually not going to be the experience that you're going to have in the market, but we want to be able to identify it. And most importantly, we want to be able to clearly and simply identify where it's expensive and where it's cheap. So as we think about that in terms of the market moving in these examples, as we were just looking at here, again, time doesn't matter here. We're in a range. We move out of that range through imbalance, aggression, seeking new value here. So then we find a new range here. Now, as we come down, we don't know if this is a reversal or if just we're coming back here to a potential support zone here where we would get continuation. So in this case, we'd have the range, found a new range, retraced back to the existing range where we found support. And then we moved on. So we get a low here that produces a high that gives me a strong low here because it does its job and gives me a new high here, right? So the process continues. I mean, here it is in a chart, right? So here, the range isn't going to be always just perfectly even highs and even lows, right? Of course, right? The reality of the market. But we can identify a range here, and then we move into a new range here. And as we retrace, are we coming back into a potential support? It's always just potential support. We don't know that it's support until we see how we come out of there. But you can, excuse me, you can look at this, and just as we were just highlighting it here, we swing, we get a higher high, we retrace, we get a higher low, and then now here we get a higher high. So these areas here are important to us because they potentially support resistance for us. Now, if we move on from that, we want to try and identify these little ranges here. Let's go back to my laser here. Back to these little ranges here, because when we identify these, this is a way that we can establish potentially a place where we might look for a support or demand zone to be expressed in the market. So if we pushed out of this through an imbalance, if we come back to revisit it, well, a couple of things are potentially here that could drive us back out of it. Now, of course, we don't know that it's going to hold. Let me get my pen back here. We don't know that it's going to hold, but we can assume that if this came out of here aggressively, it's very reasonable to anticipate that there were orders here that may not have been filled. Or said differently, traders may not have gotten the price that they wanted. So the market gets away from them. Now, those orders could very well still be sitting down there. So as we come back to revisit this demand, well, let's call it a zone or a range, we don't know if it's going to be demand or not until we see the reaction. But we can anticipate a couple of things. One, there's potentially orders there that did not get filled that could drive us out of here. Additionally, bulls that drove it up right here could very well be defending those longs here by additional support, right? So these are buy orders getting filled. This would be additional buy volume here to support the trend, because if we're going to retrace, they're looking for a higher high, this low to do its job to give us that, right? So you follow that. And I think that's making sense to you here. And the same thing here. We don't know coming into this, if we're coming up to it, is this going to be a supply zone, or if we're coming down to it, here is this potentially a change of trend. We don't know until we see the reaction. Of course, that's a function of what direction were we going when we got to that zone. But same theory on the way down, right? Are there unfilled orders here? Are bears here that drove it down going to defend here? We can anticipate that. We can look for that reaction based on that expectation. No guarantee, right? Of course, it could easily blow right through that. But this is an area to draw our attention to and then see, are there other confluence points or other technical analysis or other components that we might look for to anticipate that we get that reaction there? And if we do, can we get on board, recognizing that if we're, well, we talked about this a little bit before, if we're in here and our stop is right here and we're looking for trend continuation, well, my risk reward here is going to start to look pretty friendly, right? If I'm going after that low. Right here's the low, right, that came up here. It did not give us a new high. If as long as it doesn't break that, we don't get a new high, so it does not do its job. We'd be anticipating that this is the pivot, right? It's going to go after the week low here, so I've got nice risk reward here. Right? It's a sloppy drawing, but I think hopefully you get the idea. So when we're looking at these ranges, we got to remember that there often are ranges within ranges. So we've been focused down here on this range, but we could just as easily call the entire thing a range, right? This could be a range. If I emphasize this, so well, I know it's a little harder to see this pen, right? We could just be in that same range here on a higher degree. So how do we go about taking advantage of that and trying to qualify where we are within those ranges? Let me get that off of there here. Well, so again, coming back to this idea where we can divide a range between expensive and cheap, or premium and discount, and midline being fair value. This can be useful to us in terms of setting up the advantageous risk reward scenarios that we're looking for. So if we carry that forward to here now, this line chart that you've become quite familiar with. Oh, let me get my laser back on here. Here's the range that I'm in. Here's the last low that gave me a high here. This is not, we have no break of structure here. So I have the range here that I've defined here, where you see it here just from these white lines here. So couldn't I just as easily, right? Because this could be, I mean, this could be a 5-second chart, and we'd be putting this range in on a 1-minute chart. This could be a daily chart, and these are all 15-minute swings. The point is not the time that we're looking at. It's the range, right? The range that we're in between well, let me say it this way, the strong lows and the strong highs. This is the range we're in. Right now, the trend has not changed. We are still in an uptrend. We're just in the range, in the midst of an uptrend. We don't know it's an uptrend, of course, until we get this ongoing break of structure. But we can use this concept of expensive and discount here to our advantage to try and identify those areas where it would be most advantageous for us to be pursuing a trade. So if we stay with that same concept here, and I'm the same chart here, I'm just showing you how we could take the initial range from the low here to the high here, cut it in half. Right, so if the market is going to come down here, well, here's the first change of character. I come right to the midline. You know, I'm not trying to make a point there. Just the idea here that if you were buying here, at least you're buying at equilibrium here. Now we go into the premium here, so it'd be more advantageous for you to be a seller. But note here, I can do the exact same thing. Once I get this range here to this pivot here, well, now I've got the same range right here, and I can divide that in half. So if I'm a seller here, I'm selling where it's at a premium, aiming for that low, which would put it right. So I'd have the risk reward up here for the potential reward down here. Of course, now getting very friendly. Same, let me get rid of that here. So the same thing happens again, right? So we're coming back in here. We're getting a retrace into the premium zone. This is the target, the low this is the weak low. It didn't do its job of giving me a new high. So this becomes the target. Down I go. Right, the risk reward here would be friendly. Now you don't have to risk up to this pivot, right? You could do the same thing and cut this in half. Oh, if I can get that drawing here. All right, so now I could be a seller here. Right, it's a question as to whether or not you're comfortable with that risk. Right, there's just the decisions we traders have to make throughout the course of the day. But what I do see here is after the change of character. Now, do you note here? I've got a little downtrend going on within my uptrend. Right, lower low, lower high, lower low, lower high, lower low, lower high. But I do not break the structure. That's what's important. Now I come back up. I get another change of character. Well, let's get back to the laser. I get another change of character, so now I've got a new range. Here's the pivot high, here's the low. So now I get a little micro downtrend, right? So lower lows, lower highs, and I get a new range here. I can cut it in half. So I can be a buyer down here. I'm buying below the 50%. I'm buying at discount. My target is minimum this high because that's the weak high that didn't do its job of giving me a new low. So up I go. I get a little retrace. I get a change of character. Now note what here, if I was looking to be a buyer here, I'm entering the market in sync with the larger trend. We know we're in an uptrend. We've had this long consolidation here, or this long range, if you will, if we're going to call it a range. Now, if I'm a buyer here, I'm buying at a discount within this last range here. Oh, let's get my pen back here. So here's the high, here's the low, here's the 50%. So I'm buying in the discount range with a minimum target of this pivot. I've got additional pivot targets all the way, right? So if I can go up here and get that here, if I were to get that, and that's aspirational, now I've got the trend continuing. So the idea is the trend carries on, right? Because I do not take out the low. So I am now buying in sync with the larger degree trend, right? It's an important concept to remember. So keep in mind now that every time, so now that you're getting dialed into these concepts here, every time we approach a strong high, we have to go through this same evaluation. When we get up here, right, is this potentially a supply zone? We know, right? So what do we know here? We know we have a strong high that gave us a new low. So this is the strong high. This is the weak low at this moment in time. Now, if it breaks here and we go up and we keep going here, a la the potential path here, if we break, then this becomes the strong low. This becomes the weak high. Right? So when we get up here, we don't know the outcome, but we have a slight edge here. We can lean into that idea here. And then again, we can create risk-reward scenarios here that would be very friendly to us. So if we're a seller up here and my stop's above that high and my target is the weak low here, this is risk-reward math that's good for a trader. Again, there's no guarantee we're going to hold here. Absolutely none. We've got a pretty solid uptrend going into it. Again, think of this as being this could be a 15-minute chart or a 5-minute chart, and these are 1-minute swings coming up to this. We don't know the result until we get here. What we're anticipating, when it would be this scenario here down below, that we're coming into that and we're going to hit this range, and depending on did we come into it from below, right? Now we're going to just reverse here, or did we come into it from above? And we're going to stall, and this is the retrace before that trend carries on. We don't know. It's always a function of what's come before it. And there are other tools that we can look for and things that we can use to evaluate, is there any additional edge that I can get here that would make me more confident to take that sell? Well, the one thing I do know here, again, looking at that range, I'd be selling in the premium, right, with a target down here, minimum target of the low that didn't, so I think that's starting to make sense. Now, one thing to recognize here is these ranges here, I'm drawing them with just line drawings here, but it's not going to look like, of course, on a chart. You're going to be looking at multiple candles. So this could be, a 5-minute chart. This could be a 30-minute chart. So with a little range here, multiple candles on a 5-minute might be a candle or two on a 30 or a 60-minute before we get that big reaction. The same thing here. It's a function of what time frame are you looking at. So you take this down to the 1-minute, right? That's going to look different. Or it might be 1 or 2 candles on the 5-minute. It's just a function of when we push out of it, when we come back to it. How are we defining that little supply zone here, right? And so this is the classic down before the up, right? Or often labeled as an order block. And that would be very specific SMC and specific to Forex trading, although it's applicable across all markets. But just that concept of the last up before the down, right? And that's not necessarily a candle. Of course, we can refine that even further here. But again, the point is to recognize that a lower time frame range could very well just be a higher time frame pivot or just a candle here. All right, so we make that distinction. The same idea applies. It's just, are we looking at a 5-minute, 1-minute, 60-minute, daily? Right? Concept stays the same. Now, of course, we can refine this. Here it's just a candle, but we can refine it even further. So a range on a 5-minute could be a candle or two, a couple of pivots, the down before the up. On that's a 5-minute, and this is a 60-minute, and this is a 4-hour, and this is a daily. So on the 15-minute, that 2 candle, the down before the up, could be a couple of candles on a 4 hour. It could be just one candle. If we take it out to a daily, it could just be the wick, right? So that wick on the daily could be a range on the 5 minute. So it's all just a function of how tightly we want to tune in for that potential zone. We'll look at a couple of examples of that when we get to the real market. Now, let's just start to combine some ideas here in our theory. So back to our very primitive uptrend, downtrend. Get my laser back here. So here being the first low that I've got, I get a swing, I get a high. Now note here, on every one of these retracements here, in order for this to create that new high, it has to break a supply zone. There's going to be resistance up here. How do we know that? Because money had to come into the market to drive it down. Right? So when we come back here, you could anticipate there'll be an effort to defend that. Maybe same phenomenon, maybe unfilled sell orders here that didn't get filled at the prices that they wanted on the anticipation that that's going to push lower and we'll take out this low, right? We don't know. But if it breaks, now I have a strong low. So if I come back down here to threaten that low, at the very least, I know that I've got a low that did its job, so it's more likely to be defended. Not guaranteed, right? There are no guarantees, but it's more likely. All we get is if we can find ourselves at a point in the market where we think we have an edge, that's as good as you hope. That's all you can hope for. So if I'm retracing into a strong low from a weak high or from a weak, well, I don't know it's a weak high yet until it's broken, but if I'm retracing into a strong low, I'm more prone to be looking to the buy side here because it's a strong low. For this to become a strong low, I got to break the supply zone up here, right? And the same thing has to happen at every pivot. It's just the tug of war in the market between bulls and bears. So of course the same thing coming down. If we're gonna take out this low, we've got to break the demand zone that's there to give us the low here, to come back to give us a strong high. If we come back to that, we know this is the strong high likely to be defended because this is the weak low. If we're going to come in and take it, well, you follow along, right? So strong highs and strong lows are an important concept to recognize, and it gives us a way to label where we are or to speak the same language. So if we were looking at a trade or communicating back and forth, or you're looking at it yourself, at least we can be specific about what pivot we're looking at. Strong low, weak high. Which one is it? Now, of course, the market's not going to give it to you that easily. There's going to, and this is that same chart we've been looking at, it's going to offer complexity. So here's that same little swing structure here. Here's our change of character. Gives us a demand zone. We come up, we get, if we're going to pivot here, this low does not do its job of giving us a new high. So we get, after the change of character, now I have a downtrend going on within the uptrend, right? We looked at that before. If we're going to return to this here, just because I'm in an uptrend doesn't mean I can't participate in the internal swing structure. I've got a low here. A retrace gives me a lower high. This high does its job, gives me a lower low, breaking the supply zone. If I retrace to it, I know that I've got a stronger high here. If I'm coming back into this is potentially a supply zone to push down to break that low to do its job. Right? It starts to make sense here. And again, it's going to be easier in the line drawing here, but I have to do it this way because when we take it to the chart, it's not as easy to spot. So fortunately, we're going to give you some tools to make it easier for you. So if we're coming out of the demand zone down here, is exactly what you'd hope, right? This is the strong low that gave us the high, right? This is the low that did its job. So here's the demand zone that holds, that gives us the push out of here, that gives us the change of character. By breaking the supply zone, that gives us a new supply zone here. We retrace, I get a demand zone here. I get a pivot that does its job. It gives me a new high. If I come back to that, I know that see, now I'm in sync with the overall trend. So I have a stronger low here. If I retrace back into the demand zone of that low, I know it's a strong low. I don't know if that's going to give me a new high because it's got to break that supply zone there to do it. We come back up here. We come back into the upper range, the upper supply zone, pivot, change of character. So I get a little downtrend within my uptrend. Now here we go again. I got another change of character here. I've got to get through that demand zone. I come back here. This is the low that gave me a new, gave me the change of character, right? So I have the stronger low within the internal structure here. So this is the weaker high as it did not give me a new low. I come back into that demand zone. I've got to break that high. I've got to break the supply zone. And then ultimately I've got to break the upper zone here, which was tested once, but I can't continue with the trend until I break the structure up here and that trend continues. right? So it all starts to come together. Now, I'm going to add a little complexity to this. Excuse me, I add a little complexity to this. I want you to look at this for a second, because the odds are you're using this without recognizing it already. Right? It's just a matter of qualifying and quantifying and being specific about the swing structure, both the dominant swing structure and the internal swing structure. Now, again, this is that same little impulsive move up, and I've just added a little more complexity to the internal swing structure. See if you can spot that. Only thing I'm going to do here, I'm not going to change anything on the chart. I'm just going to add some labels. Do you see it? So if you're familiar with any of our teachings that we've done here on the crypto space or across multiple assets here, where we go beyond day trading and we're looking at 60 minutes and above, you know that we're advocates of Elliott Wave trading and the Elliott Wave Theory approach to the markets here. And again, I've just taken the exact same charts that we're looking at here, and all I've done is just give it Elliott Wave labels here. So here's my impulse here with my little zigzag into my fourth. That gives me the change of character. That gives me the break of structure. That gives me the fifth. That gives me my pivot up here. So I know I've got an uptrend into my impulsive one wave. Now I get a little zigzag on the way down. So here's a little downtrend. Here's the change of character. Well, I get this would be the first change of character. Now we're just continuing in the downtrend here. I get a 5 into an A, which gives me a low. 3 into the B, which gives me another low. So I have a potential low here, potential high here. I don't know the outcome yet. I retrace into this supply zone here, come back down. For this to carry on in this pattern, I've got to break the demand zone here of the A wave. Not to deviate into an Elliott Wave lesson, but I just want you to see this, right? Traders have been using this. They just haven't labeled it this way specifically until it was kind of organized in this fashion. All right, so thus, you can see the attraction is why I was drawn to this and wanted to create this both as for our day traders as well as something for our longer term traders, because you're already doing it. You just don't realize it. So here's my A, B, C. Now note here, I'm below the 50%, so I'm buying at a discount. If this is a 1 and this is a 2, I'm looking for it below the 50. Now I come out of here, I get another little upswing, a little impulsive one here. I got to break that supply zone, retrace here, and I come, now I get a little change of character here. If this is going to be the 1 through a 5, and I'm going to get 3 back down here, I might come into a little demand zone here, up I go. I'm going to bump into this supply zone here at the 1 of the internal 3 here. Again, I'm assuming if you have any Elliott Wave knowledge here, this would make sense to you. I'm retracing into the 2. Now up I go, and here I even put a little triangle into it, because you can see here we're double dipping into that support zone here, and then off we go. I get a break of structure, so the internal trend remains intact. My point being, you're doing this already. You just aren't labeling it this way. And it's just, I think there'll be advantage here to how this can augment how you're already approaching the market. Let me kind of focus in on some of the entry techniques, or things that we would look for with regards to now entering, now that we have some terminology and some things that we look for. And again, very likely these are things that you're doing already, perhaps not recognizing that you're using some of these price action or SMC concepts already. So let's keep it relatively simple here. So this being a swing, a retrace, an internal retracement. So it maintains the structure here by staying above the low. So I get a higher low, I get a break of structure. If I'm coming back to that, okay, well, this is the rudimentary pattern here. Now, if you were thinking Elliott Wave, right, what does that look like? All right, looks like a leading diagonal. Not to digress in that, but these are patterns you've seen before. So as we retrace into this, if this were going to be an A, B, C, or a 1, 2, 3 of a diag, we'd want a deeper retracement in the. Not to digress there, but same thing up here. Break of structure here. This break of structure, we retrace back into that supply zone. This is. There are times the market will give it to you this easily. Not always, right? But you can spot this here, and this will have, of course, you'll have multiple candles coming into this, but I just want your eye to start getting tuned into, oh, wait a second, I've had a break of structure, or could be a change of character. If I'm retracing into that pivot, I want to pay attention here because I have potential. Back to where we started. Unfilled orders could be there. There could be bears in this case here defending those shorts, looking to break the low. Why would they be looking to break this low? Because if this is going to hold here, if this zone is going to hold, this would be the strong high that gave me the low here. So the target from this becomes the break of that low, because this is the weak low, right? This is the weak high. Didn't do its job until it gets here. Now it has done its job, and this becomes the strong high. I think you guys are starting to get that. Now, a little bit more sophisticated here, where we're just adding, well, essentially you would call this a flip. So we're adding a double break of structure. So we're coming down, right, typical swing structure here. I get a final break of structure. So I know that at least at this degree, I have a downtrend. So if I'm going to retrace back into that, well, I'm back into that supply zone here. The anticipation would be that this is a pivot, because it's a lower pivot. It's going to do its job, right? It has a job to do, which is to take out this low. If it can't do it, right, now I start to come back the other direction. Well, the first thing that's going to happen here is I'm going to have a change of character. We could label that as a failure reaction. But in order for this to carry on, well, I've got to break the supply zone that's right here. So if I'm going to do that here, well, now I've got a break of structure here. So I've had the change of character, and now I've got break of structure. So I have the potential here now for the trend to have changed. If I retrace back down to this demand zone here, I want to pay attention. Right here, I'm just adding a little complexity to what we had over here. And this is the way to look for it, right? And this, again, you're already doing this. We come into a low here. What's the first thing you're looking for if you're considering a potential trend change? Let's say it's 11, 11:15, 11:30. Europe's just closed. You're trading the stock indexes. What are you looking for? You're looking for that first higher low, right? That maybe, okay, maybe that's potential. But this is the very aggressive way to approach that, just off of the fact that, hey, maybe I've got a higher low. Well, you know, of course, if you've done any day trading, you know that could easily just do that, right? There's no guarantees. So the more conservative way to approach this is to wait for the confirmation, break the structure. So this is the start of it. This is the next piece of it here, where if I can break that demand, because we don't know, that could come right back down. But if it breaks there, well, then now things are starting to look better, right? So now if I get this break here, now I'm coming back into that demand zone here. So traders had to get aggressive here. Money had to be committed here to get through that supply zone, because they got to fight the bears that are there to push it back down, because they're after the low. If we break through that, and then if we start to retrace, well, I want to pay attention when I get down here, because I want to look for an opportunity to buy before that low is broken. Because if that low is broken, then I've got a change of character. Right now, it's potentially a demand zone, and I can lean into it because I've had the substructure here set it up, right? So. Right, here's the first, right? I don't get a new low. I get a failure reaction. I break the supply structure here, the supply zone. I get a break of structure. Now, if I'm coming back down, heads up. I want to pay attention. If I can refine that to a zone or a candle or a wick or whatever the case may be, depending on what's there, and if I can get in on the discount range of that range, boy, is my risk reward looking good. Now, of course, this is going to present itself in a variety of patterns here, where you're going to see this here. Again, this is kind of simplified. Here's the first clue that should draw your attention to it. Okay, I got a change of character. Now, what's right here? I mean, you could look at that and say, oh, head and shoulders. You could think Elliott Wave, oh, A, B, C. You could think of it as an FX trader. Well, oh, okay, well, there's an M, right? So there's a number of different ways we can evaluate this, but it's this pattern here. It's the failure to take the high. But it's more than just that. It's the break of the low that leads to the failure to get to the high. Now, right, now you want to pay attention. Same thing here on the other side. Just a little more complexity here, adding now the change of character. So this is a flip with a change of character. And what we're flipping is the short-term trend. So we get the higher high, retrace. Now, it's all there, ready to go for the higher high. Doesn't get it. So first I get the failure. Right, there's the failure reaction. So that becomes just the initial first break. Then I get a change of character. Now, if I'm coming back to that, if I get this retrace, I want to pay attention here. Because same, right? unfilled orders, bears defending, target is the weak low, right? You see how it starts to come together? Same thing down here, same pattern here, just on the other side where we've got the failure, the change of character. If we retrace back, I want to pay attention. And it's going to present to you differently, right? It's always going to be, the market's not going to make it easy for you here. So here it is without the change of character. I get a little retrace here, but I don't quite get the change of character yet. But I get a swing, I get a lower low here, I get a lower high. So I have potential here. This is up to the trader's discretion as to whether or not you want to take that trade. Well, at least I'd be buying selling in the premium. My stop would likely be here, depending on what time frame and can you is that an appropriate risk tolerance for you and your account, etc. If we come down, we break that. What's the target, right? The prior low. And again, same thing over here. Everything here is just inverted, so you can see the other side of it. Now, of course, you see this in the market all the time. Perhaps it just hasn't been framed and presented to you this way. So let's go over to the market here and just take a look at a few examples. So here, this is a chart of Bitcoin. Now, of course, you could label it. You could do all the work yourself. So you could identify the strong low, the weak low, the range, all the changes of character, the breaks of structure. You could do it yourself. And many that trade with the Smart Money Concepts protocol do it just that way. Of course, if it's possible to have greater efficiency and reduce potential errors, infinitely more efficient to have a piece of software do that for you. So now, some of you, of course, are aware that we have spent the last couple of months working on an indicator to take these concepts and apply it to the futures market on our Ninja Trader tools, right? And so we've been working on that for some time, and we considered doing the same type of thing over in TradingView. And as we were looking around, and just determining whether or not this had legitimacy and could be an additional tool that would be useful to us in the crypto, all of the assets that we trade. Well, we bumped into another company here that was relatively young, a talented group of guys that were already well down the road of doing this on TradingView, and they had a very, very well-designed set of tools and indicators here to apply this conceptually to within TradingView. So rather than try and create our own version and compete directly with them, we reached out to them and thought we might be able to work some sort of cooperative deal, and indeed we have done just that. So I'm going to be presenting to you this indicator and these tools here. You'll get a first look at it here, and then in the second, third videos, we'll go into more detail about what their set of tools offer to you, how to use them, on the nuances, parameters, etc. But in this video, really my purpose here is to demonstrate. We'll go through the theory as we've done, and now go to the market, look at some examples, so you start to put the pieces together, and then perhaps this is something that you might want to look to augment what you're already doing. We have arranged for a trial for you guys. This is very reasonably priced software, so I think you'll be pleased when you see that. But for the time being, let's stay focused on the theory here, and we'll get into more details on the software and the tools in the follow-up videos. So here we have Bitcoin here, and so the software has done the work for me. You see, obviously, all the little changes of character. Now, a couple of things to note here as you're looking at this chart. The larger swing structure here is in white, these breaks of structure here, and the strong low here is seeking a new high. Changes of character. So you're looking at the combination of both the larger swing structure as well as the internal swing structure. And I'm just making that distinction between the two. Internal swing structures in orange here, and the larger, the dominant swing structures in white. So you see all of this internal in orange here. So you see as we come down, here's a change of character, break of structure, gets vanilla, here's the change, right? So you see everything we've just been talking about through those line charts applied here now to the Bitcoin chart. What have I got here? This is a 1 hour. And here's a section where we have both a change of character as well as a break of structure. So I have an internal structure here. There's a change of character, but the dominant, the larger degree, that's also a break of structure, right? Which leaves behind here a little demand zone. So looking at this now, what I want you to focus on is this section right here. Now, of course, remember, I want you to bring you back here to this. We talked about these these demand zones and flip zones here where we have this kind of a structure. Again, this is happening in the market every day. So you perhaps haven't had your eye dialed into it this way. We can look at this. I mean, we talk about this all the time, right? Here's a break, retrace. Now, this would be a deep retrace, of course, well beyond any golden zone from this pivot, but from this pivot, looks about like a golden zone. But not to digress into that, but as we now take this image here that I want you to have in your mind's eye, let's go back to that same Bitcoin chart. So if you take, well, here, I can use the pen here, but let's do it this way. So you see, here's the initial swing, the retrace. Here we go up, we break structure. So with that break of structure, as we head back down, we have left behind a demand zone right here, right? So here's the demand zone. Oh, let's get that off there so you can see it. So here, this is the last down candle here, last low prior to this change of character, and ultimately we get break of structure. So I know down here the market has left this demand, we'll call it an order block demand zone here. Most common language in the SMC community would be an order block, although I think we tend to lean into the phraseology of a demand zone here, but whatever you like, they're almost interchangeable. Although order block, there's a little bit more nuance to it if you're talking about Forex. But here for our purposes, right, so you see the swing, the retrace, the break of structure. Now we come all the way back down, tap into the demand zone. What would be your first target, right? Right up here, right? The prior high. Now this ends up going much further, but I just want you to see the swing structure here. Up, now we come all the way back down, right? Should look just like what we just looked at here, right? It's the exact same thing. We go up, we come back down to the demand zone, off we go. So that's what I'm just trying to dial your eye into that here. So let me get that off of there. Okay, so let's go look at a few other examples here. Oh, I've just tried to pick some things we've looked at, either in live streams or in videos here, things that have been moving of late. I went back and forth in time just to show you a variety of examples. So this is a Solana against the dollar tether here on Binance. This is a 15-minute. So you can see here, well, here, let me get to the laser. I think that's easier for you guys to see. So here's the last little pivot before we go up and get all of this. Well, here's the change of character, all of the internal, right? Note the distinction between the internal swing structure and the larger swing structure. So this is the last down candle, the last little low that produces that change of character. So it leaves behind this demand zone. The market goes through all the gyrations, comes all the way back down. Now, note, we're tapping it here. Now, one thing to note here, just in your mind's eye, look at it this way. If I'm looking at this as the low, at that page, this would be the high. Well, you can just visually see that we're just past about 50% here. So we've come into the discount zone here. We're also right on the edge of value here. Interesting. On this 15-minute chart. So tapping back into this demand zone after all of this, the internal swing structure brings us right back down to it. Let me get that off of here because there's actually a couple of ways you could have entered this. Well, here we get, so here you can kind of see that little range that we talk about as the market is chopping inside of that range. Now, here's the first little push. Now it comes all the way back down for one last little tap into the demand zone. What's the target? Right, the prior high, right? So here we can just look at that as the target. Here, let me get those off here and get back to the laser. Here would have been my target, right? So you could have taken it here. If you missed it here and you didn't see it, perhaps you have alerts set. Could have been any number of reasons that you might have missed it here. Could have been sleep, right? I don't know what time it was. It could have been 12 at night or 12 in the day. But you get the second opportunity to get on board here, right? So you just visually look at the risk reward here, very favorable, right? Goes right almost in a straight shot. Ends up going much beyond that and actually takes out the dominant high up here. Just another good example. Let me get rid of these here. Just a little bit further on. So, well, if I go back here, you can see here we've gone up. This is right about 95. We're pushing 97 here. So all I've done here, here's the last little push here. Here's I guess that was the target here. Here's 97. So it continues to go higher. We get up to about 102, and then we start to come back down. Now we get into that range again. Now here's the last low. The last down candle that gave me a low that broke structure here and gave me change of character here. So this is the demand zone that it leaves behind. It actually comes back and taps it twice. Here's one, does not break structure here. Comes just a tick before breaking, but then comes all the way back down to pick up any stragglers here, fill any unfilled orders, any latecomers here that missed, bulls defending, you know, we can surmise what's actually happening down there, but what we want to see is evidence of the pivot. So as we come down here, now this is a 5-minute chart. So we really dialed this down here to get as precise as we can. So again, risk reward here would be very, very friendly. I mean, it's literally straight shot here to break that structure. Comes back down again. You would have left another one here because this is the last low before the break of structure. So you could make the same case that you had, well, here, if I draw it, you had another one right here that it frames out right here, these two right here. So we come into that. There's the break of structure here, and that, I mean, that's quite a rip that we got out of that. All right, let me keep going here. So, what have I got here? Oh, let me go. Oh, this is Zilliqa, which just ripped recently, so I thought I would use this. Actually, a good example here. I thought I would just make a point of showing this. So here, just as if you recall from the line drawings, here would be the high that leads to the break of structure. So these are the strong highs doing their jobs, right? So here, this high causes this break of structure that gives me the new high. We retrace. Now this high, being a strong high, breaks structure, gives me a new low. So these are highs that are doing their job. Now, I thought this would be worthwhile just to give you an example. So if you look back here and you say, well, wait a minute, what happened here? Looks because we broke that pivot. Well, one of the nuances of this here, you do actually have the option to set this how you like. But what I would encourage you to look at, because it would be a stronger signal here, is that a break of structure would require a close above the pivot high, which we do not get here. As a matter of fact, this is actually only a change of character over here, because even though we're getting little wicks through here, it's not until we get here that we get the true break. So the trend remains down, even though we retrace all the way back to it. In fact, wick through it here, so you can see, you know what's happening here, right? Stops are getting run. This is liquidity grab. We come down here now. This or this, either you could look at them either way. Neither one do their job. Right, they don't give us a new low. So when we break here, now we've definitely had a change of character. Now we come back all the way up here. Again, why is that not a break of structure? Because we don't have a close above. So we come all the way back down. So the trend remains down still per the swing structure, the larger swing structure. Right? No closes above the prior high. Now we come back down. We get another change of character here. You'll note here that it's leaving behind demand zones here, because these are all causing internal changes of character and breaks of structure. So we've left one here. This would have been stopped out, but there's one down here. So now as we come here, we're looking at right over on the corner here. We'll get there in a second. I just wanted to draw your attention to that distinction, so you weren't looking here going, why is that not the break of structure, right? Because no close above it. Oh, this is a little bit further into that. So here's that last swing high that we were looking at here. We don't get the change of character. We don't get the break of structure here. So we come down. We were just looking at this. So now we come into a little bit of a range where we get some chops. So you get this. So from here to here, we get in that little bit of a range. Now, this becomes the last low that gives me a break of structure. So it leaves behind that demand zone. Right, so if that comes back to be revisited, that would be an area of interest, because we can see now what's happened. Well, if we push on a little bit further, this is as you see what has happened. So here, well, let me go back. Here's the zone right here. We see it at 38, at 0.038. Excuse me, 0.038. Right, so here's 0.038 right here. So the market goes up, comes back down, taps right into the demand zone. So if you were long here. Oh, and this on a 1 hour, I'd want to see it get into the discount zone of that little demand zone, right? So commonly, this would be a great spot to have a limit order here. If you were looking for this, we know the trend is up. Note this is the strong low, right? Because this is the last low that did its job, that broke structure, so it gave me a new high. So this is the strong low. This would be, that's the swing high. SH is the swing high. This is the strong low. So I have a swing, but I have the strong low. As you can see noted here, I did that just to emphasize it. So up we go, retrace, leaves behind, because that gives me breaks of structure. We come back to it. If you're entering, typically I might be a tick or two in front of the 50% of the zone. Now remember, this is a 60-minute chart. So we literally tag the 50% here. Right now we'd be in. Now consider our risk reward. That's 15.36 to 1. Pretty good risk reward, which is one of the real advantages of this type of trading, is because we are entering so close to where we're wrong, right? So you don't want your stop a tick below the pivot. You got to give it a little bit of breathing room. But just looking at that risk reward, I mean, here's 15 to 1. Right? So entry here, where's your target? Boom, right? Got a couple of dips into it, right? Just to test it. starts on the way. So in the process of getting there, it creates another stronger low. So clearly we have, so this now has internal structure here. You see breaks of structure. Now I get up and I get another break of structure here, which leaves this demand zone here. Pardon me, leaves it here. This is the break. But we had ultimately get our 15-to-1, right? Silica. Nice example of it. Oh, what do I got here? Here's Cardano. Oh, here I've got, so you see the strong emphasis on the larger degree swing structure. So here's the break of structure. So the high up here has done its job, gives me a new low. We retrace, and I come down, I get another break of structure. So here I have the strong high. Right, understand? So as we're coming down, here's the break of structure. So this is well, actually, excuse me, it's here because this is all wick, but that still remains the strong high because it's given me a new low. So as we retrace back to it, I've got a little supply zone here. This is the last up candle here, the last tick high, this little range here. What have I got? I'm on this is a 15-minute that did its job. Gave me a break of structure. So now if the market works its way back towards that supply zone here, I'd call that an area of interest for potential trade setup. Well, as we come back up here, it tags it. If you're looking for it to get into the supply zone here, there's a pretty good setup. Pretty close here. Ends up getting filled here just with a wick through the 50%, then all the way back down. So what'd you get there? 9.64 to 1. Right, and that's the first target. Right, so you can just see the range that it's in. So selling up here at the supply zone here as it's tapped multiple times, targets the low. There's your 9.64 to 1. Oh, this is Bitcoin again. Here's that section we looked at earlier here. I thought this might be interesting just to play it forward. So the very first slide that we looked at here, we've got that swing up. Here's the break of structure, back to that demand zone. It's the first slide we looked at. Well, this carries on, right? We get quite this big rip that comes all the way back down. Now, the thing to note here, note that there is no close below this swing low here. This low, this is the last low before this launch that creates the break of structure and the change of character here. Up we go. Now I've added a couple of moving averages here. This is this is a 9 and an 18 common. This is commonly used in SMC, right? So the ICT and his followers, this is one of their favorites, is the 9 and the 18. So I applied it here. I thought we'd just see how that looked here. It's actually quite good for shorter term stuff here. Right? Looking at here, so we can see we've got a clear uptrend here. So even though we get this just dramatic retracement here, the moving averages aren't crossing here. So I did do a little, go Ukraine, right? So I lose the Ukrainian colors here. But not to digress, so we come back down. So look, we go all the way up here, and then we come back, right? Just to pick up any late stragglers. Could be that they're defending, could be there's unfilled orders, because look how quickly we came out of this. So you had this massive volatility, then we come out of here, right? Very reasonable to anticipate there are unfilled orders that here, and any bulls that caught this move would be defending here. So you can see this is an area of interest, right? Your target would be highs, right, which it gets all of them. So nice risk reward here on the retrace. So when something takes off like that, pay attention for the retrace here, as you might have a secondary onboarding here. So we go here, and this is the last break of structure. So you can see we're leaving a little bit here. Market carries on. Oh, let's see. That's what have I got? That's the 1 hour of the spot trading on Femex. Oh, this is same chart here a little bit further on. So here you see here off of this one, we've gone up. Now take note here up at the top. This is the last up bar before this massive downtrend started. So as we work our way all the way back, I mean, this is relatively recent, right? You probably recognize the price action here. As we work our way all the way back up towards that potential resistance here, we've got a supply zone here. Right? It's the last pivot that created all of this internal swing structure here that gave us this, that gave us this. Now we're going up here towards this pivot. This would be an interesting area to be looking for. So you'd want to see certainly something. If I was on the 60-minute, I'd want to see it at least tap, or it might be a couple of ticks in front of the 50% of the zone up here. So let's just see how we end up here. So there you see it, right? If you're sitting with a limit order right at the 50%. Now look at your risk reward here. I mean, reasonable amount of risk to the pivot high, right? You're going to give it a little bit of a cushion there. You want to be one tick over the top of the zone. So you give it a little cushion there. So there's 6 to 1. Target would be the prior low down here, right? So either of these. Now note here, if you're coming down, you're going to have to break that demand zone. And the other thought here, since this is a 60-minute and we're coming up pretty hard, perhaps you'd want to see something a little bit more like something like this, like we looked at earlier, where you might say, okay, if it's going to come up there, show me the break and then the retest, right? Then I might be a little bit more comfortable, because if if you look at that thing, we're going straight up, right? That would be uncomfortable if you didn't have this as a reference. But pushing through that, if I go back looking for what happens, well, here's the first trip up. So if you were uncomfortable because this is coming so hard, comes all the way back down, it does not break this low. You note here, this is the low. We don't get a close below it. So this remains the strong low. So all the more now here I'm down to a 5-minute here. You'd want to see this kind of setup here, because I have a swing high. I know I'm in that larger demand zone because I've gone from the 60-minute down to the 5-minute. As I'm retracing into this, well, if I'm going to take this, the fact that I've come back to it makes me a little bit more comfortable. So now on a 5-minute, I get a second supply zone that is within the larger 60-minute supply zone. So as I come up here and tap this here, my target would be the potential pivot low. I don't know, let's see, we come up here, we get filled here, it comes all the way down and literally hits it to the tick, right? So there's a 6-to-1 coming out of that. So you see how we are at a supply zone within a larger supply zone, right? So down it comes, literally ticks it. Beautiful trade. This is a little more Bitcoin. This is a 15-minute on Femex here. So here, we've got a little... Here's the last pivot here. I just highlighted it here for you. So we're coming out of a supply zone up here. We've come down. We've retraced. This is the strong high, because this is the pivot that does its job, that breaks structure, that gives me a new low. Right? So as we now are coming back to it, this would be an area of interest, because this is the last up candle here that gave me the break of structure right here. So I know this is a potential supply zone here. Now I've come up, I've wicked the very edge of it here. Now note, the high of the pivot just ahead of it here is a little bit higher, and we come up and we literally double top here, but there is no close. This is a good example here of why you don't want to be one tick beyond it, right? Particularly if there's a little bit of a wick here that's got a little bit more distance. So what's actually happening here, right? We can deduce what happened there, right? Stops are run right here. So those stops are run. So as it comes back down here, even if you didn't, perhaps you were right here, perhaps you wrote it, perhaps you waited it till it came back down. But if you got that, we got a clear target, right? So our target is the prior low. But on the way to get there, you're going to have to break the demand zone. Now, this is the strong high, which is why you'd be inclined to take that trade, because the assumption is, this being the strong high, that the more probable, unless we get a trend change, that you're going to take out this low. But again, note, this is coming out of a demand zone. I've got a demand zone it's going to have to clear, but I still have the strong high. So a trade worth taking, it's a 6-to-1 trade. Here's your target. What happens? Well, it comes down and bumps into the demand zone and actually ultimately gets stopped out, right? So we just want to be sure. You have to recognize here that supply and demand zones are being created across all markets on both sides, right? Just like a measured move, right? So look like golden zones. And 50s, they're going to be on both sides, right? So a lot of it is, okay, which side has higher probability of holding, breaking, and the influence there would be where the last strong high is. Well, in this case, right, it just doesn't work out, right? So if this keeps going, so if you took this down here and you got to this point, well, okay, reasonable to assume that maybe you reduced your stop a little bit, right? So maybe you're in a scratch. I mean, it's up to the individual trader how you would manage that here. But if I saw this now start to react out of that, I would at the very least be at break even, right? So in case we get a trend change, and actually we end up, that's what we get. So here, this is ETH now. I just switched. I'm just kind of bumping around from different assets. So here, where are we? I think I went back a little bit. Here's a 15-minute on the ETH perpetual contract. Or am I on Bybit? This is a 15-minute. So here's the last low. Here I've just put these little highlights on it. So here's the strong low. We get a swing. We get break of structure here, right? So as it comes back down, now I get a new low here. So if I'm looking at this range here, I want to say, okay, well, if I measure from the low to the high, I'm interested in getting into the discount zone. So I've just now wicked below the 50%. So I know I'm in the discount zone of this current range. Right, so once this goes up and creates that internal break of structure, it leaves behind a demand zone. So that last down candle before it goes up. Now, as I retrace back, now I'm in the 50%. I'm in the discount zone. I've got a demand zone there. That would be an area of interest. So as it comes back down, it literally ticks it. what happens? Oh, I went kind of fast there. Here we're in the trade. Now, in a 15-minute here, you got to be mindful of you're compressing the range of entry here. So when you go from a 4-hour or a 60-minute down to a 15-minute, you don't want to create a zone that's so tight that you might miss the ride here. So when I'm down on something like a 15-minute, and we're talking about 302, what's that, 290. This is a really tight zone here. So I'd be more inclined to be looking, if it taps the zone, I'd want to be in. We know where our target is, right? Here's the strong low, right? Here's an example where this is the low, right? Here's the last low here that gave me the internal break of structure, but here's the dominant swing low, right? So the dominant swing low here gives me this internal break of structure. So this is what's creating the discount zone for me. So I can see that I'm in the discount zone. I've got this demand zone. I got a target. Boom, up it goes, right? So there's 5.37 to 1 off of that, right? And I could have kept going, but this would have been your first target, right? So I'm just going to use first targets. Some of these go way, way, way beyond, right? So there's nothing that says you have to get out here. Just demonstrating how you might identify, oh, is this an area of interest, right? Are we in the discount zone? Where's the strong low? Where's the weak high, right? So if I come down here, strong low. Oh, let's see. Here's ETH. This is perpetual again. I've got a zone here. What am I? I've got a 1 hour here. So here's a demand zone that created this break of structure on the internal swing structure here. Goes up. Now we're coming back down. Now I get a new strong low here because this is the low that ends up causing, well, it causes this change of character and this change of character here. So I know that I've got a strong, this is the strong low. It left behind a demand zone. Now you say, why is the demand zone not here? Because this low didn't do anything. It didn't create a change of character or a break of structure. So this is just this is a pivot low, but it's not a demand zone. A demand zone has to do something, right? It has to cause either a change of character or a break of structure. So this is the last this is the last low before we get the change of character. We get it internal as well as larger degree. So if the market's going to come back down towards this, I'm interested. Right, so, what do we do here? So we come back down, literally tick just inside the discount range of that bar. Here's the target. Another 6 to 1. Oh, here coming back the other direction. Now we've got here's the strong high. I think I just went a little bit. Now it's April 10th. This is a 1 hour. We've had this move down here that created a break of structure, meaning it left behind a supply zone. This is the last up candle before the break of structure. So I know it's left behind a demand zone, or pardon me, a supply zone. So if we're coming back to it, I'm interested. Right now here we literally are ticking the 50%. I mean, that's to the tick, right? So again, you don't want to be right one tick beyond. So give it a little cushion on the other side. This is the 200 EMA, right? Well, it's actually the God EMA. What's the average of the excuse me, the average of the EMA and the SMA, but it's just a good reference point here. Where's the trend? Are we above or below? Right. So we know as we're retracing here, this is the strong high that did its job. So if we're retracing here, now look at the risk reward here. Right. You're literally just risking from the 50% of that zone to just a couple of ticks on the other side of it. Gives me a 7.88 to 1. There's the target. What do we do? Right now, so we get it, and interestingly, it looks like it leaves another one behind. So there's the 1 hour here. So when it retraces here, it actually, you can see it. If I went down to a 15-minute, I can see the supply zone that it left. So if I go back here, you can see this retracement here. If I'm looking in here, well, on the 1 hour, I don't see it. So if it's coming back to that, I'd want to dig in a little bit deeper and say, hey, is there something there? Well, if I go down to the 15-minute, I can see this is the last up candle. It gave me here's the change of character. Right, if I come back to it, area of interest. Now, what is that giving me there? There's 11.23 to 1. Here's the target. Here's the strong high, so I know the trend is down. I've retraced all the way back to that supply zone. Boom, 2 candles. All right, so there's your 11.3 to 1. Nails it. All right, so there's a couple of good examples. So I just wanted you to see, here particularly in crypto, we'd look at some examples of this being very effective. It's nothing to, I don't introduce this to you to confuse you in any way. It's something to augment what you're already doing. I mean, at the end of the day, what are we doing? We're looking to sell at supply zones and buy at demand zones, or sell at resistance and buy at support. I mean, you could simplify this down to that very basic structure is all we're trying to do, right? We're framing it a little bit differently, and we're being very specific about how we're defining uptrend, downtrend, and the last events, and then the combination of both the larger swing structure and the internal swing structure, just like an Elliott wave count, right? We might look at the internal wave count here, so you can see a 1, 2, 3, 4, 5 here, A, B, C coming down here, but it would just be like the waves that are within waves. So at the end of the day, really what we're doing is saying, hey, this is potentially resistance. This is potentially resistance, right? So if I can sell up at resistance and buy down at demand, right? So again, it's much more nuanced than that as you get into, okay, where's the change of character? Where's the break of structure? Is that internal? Is that the larger swing structure? This is deceptively easy at first glance. Of course, along the way here, now there are many zones that are being broken, right? So you can't just take every zone that comes along, right? There's more to it than that. And we'll look at some examples in a little bit more detail as we progress through this. But I just wanted to get this to you so we could introduce conceptually both the theory as well as you seeing it in some crypto markets here that I know you're trading, and perhaps this is the first time you've actually seen it framed this way. So anyway, I hope that's helpful to you. So stand by here. We're going to have a lot more content and a lot more training on this, and you'll see me now start to incorporate it into some of the things that we're already doing, and the purpose there being, how are you using this in addition to everything that we're already doing with regards to geometry and measured moves and Elliott counts, etc. I think you'll see that it dovetails in very nicely when you start to add those components to it, and then we look at the specificity here of swing structure, which, just to wrap on this, the thing that I like about this is that there's no ambiguity about where the trend is, or where the change of character was, or where the break of structure is. Unlike an Elliott count, where, God, is that A, B, C, or is that 1, 2, 3? Or there's some subjectivity to it. It's open to interpretation in Elliott. Two traders can see two different things. Here, a change of character is a change of character. We're either doing higher highs and higher lows, or we're not, and that changes. We either have a break of structure or we don't. So it's very deliberate, very specific, and very logical, which is what attracted me to it. And I thought, having now spent a lot of time with it, I thought that this would be a nice way to augment what we're already doing, both for those that are not excelling with Elliott Wave, to give you another way to approach the market, or perhaps a way to augment what you're currently doing with some of the things that we're already teaching. So with that, I'm going to wrap this video. I know I've gone very long here, but I've been working to get this to you for some weeks now. So with that said, stand by, because we'll have more videos coming this week, and we'll get into all the nuances of this particular piece of software and these indicators put together by these guys. Okay, we'll introduce them to you this week. Okay, guys, with that, I'll wrap it here, and we'll be back soon.